time for Lykken on Lending.
Welcome, everybody. Good to have you with us.
Welcome to Lykken on Lending, a weekly mortgage market update providing up-to-the-minute information on interest rates, loan programs, and hot industry news, all related to the mortgage industry. Brought to you by Transformational Mortgage Solutions. To participate in today's program, our guest call-in line is 646-716-4972. Now here's your host of Lykken on Lending, David Lykken.
Let's begin.
Listeners, I am so excited about every one of our interviews, but this one is super special to me because of who we are going to be talking to. One of the most innovative individuals in the industry who's come up with more outstanding ideas at the right time in the marketplace. And I thought I originally met him through David Kittle, and Arthur told me, I know we used to do business together, and that brought it together. But I invited Marc Helm to join me in the interview. Marc, good to have you here. Appreciate you joining in on this interview.
Glad to be here, David. Thank you.
And we've also added Mr. David Kittle, a dear friend, and someone that does not need an introduction, but also one of the co-founders of TMC. So David is a regular on the podcast. And David, I want you to get this interview started by telling us about Arthur Prieston, and then I'll add to it afterwards. Go ahead, David.
Great. Well, thanks for having me today, David. And Marc, good to see you as always. Thanks for having Arthur on today. As you said, David, innovative and timely, and I believe this is just the perfect timing for your listeners to hear Arthur. He's been a friend of mine for 35 plus years. He's a CMB, knows every in and out of the mortgage industry. He's an attorney and had come up as he is, as you said, a visionary with a rep and warranty insurance program 30 plus years ago. And it couldn't be more timely than it is now, with volumes low and the GSEs pushing loans back for repurchase. So I'd like to introduce my great friend, Mr. Arthur Prieston.
It's good to have you here. And then I was being introduced to Arthur, and I go, Arthur, nice to meet you. And he says something. One thing I love about Arthur is he is such a human being. He's such a warm individual. He says, David, you don't remember me? We used to do business together. And our last mortgage company, Arthur was the one that came in and did some very innovative things for us. And so, Arthur, I thank you for reconnecting and helping wake up some of those old brain cells. That was a long time ago,
Right.
but it was really good. What impressed me back then, and what has impressed me all along this journey, was how you seem to come up with the right solution at the right time for what we're going through in industry. And we're going through unprecedented times right now, Arthur. But before we go there, tell us a little bit about your journey in mortgage banking and, bring us up. How did you get into this? We'll go from being an attorney to what you're doing now. Give us a little insight to your journey.
Sure. And before I do that, though, I've been listening to Lykken on Lending for as long as it's been born. And I tell you something, I don't listen to it at night to put myself to sleep. I have to actually listen to it during the day to learn a few things. And every time I do, I pick up something new. And my dad always told me there isn't a meeting worthwhile if you can't just pick up one little tidbit. And I always do in your podcast. So it is an honor and a pleasure to be on this podcast with you.
Well, thank you very much. It's an honor to have you here, sir.
Well, to answer your question, and for David, talking about 35 years, I did practice quite some time. I have recovered from being an attorney, frankly speaking. And it really does mean the fact that and I'm going to make everybody feel somewhat dated on this call, during the FIREA period, when FIREA was first announced back in the late 80s, early 90s, it's when, Freddie Mac came out with its fraud squad and quality control was now in place, and 10% reviews on post-funding. And well, we all discovered exactly the kind of stuff we were originating and making back then, and it was somewhat embarrassing. So it tightened up a lot of screws that needed to be tightened. But most importantly, it also exposed a lot of liability for mid-sized lenders. And we all know that. David, both you Davids here know that in particular what happens. And Marc, on the servicing side, you understand that, when you're servicing loans and you're looking back at a lender and that lender is worth about $150,000, it's not a whole lot of significance when you have a rep and warrant that requires them to buy a loan back. So back then, I was working with Western Region Freddie Mac, and it was a wonderful woman named Bev Kennedy. She was responding to every one of my emails saying, please stop emailing me, come on with all these questions. I said, listen, I need some guidance. And she mentored me for a number of years, and God bless her. Since her passing, I've missed her many years, for many years, but more importantly, she was instrumental in helping me come up with a concept that basically said, look, mid-sized lenders need some paper behind them. They need a few $1 billion of insurance cover so that their rep and warrants, are somewhat meaningful when they're exacted by a repurchase request. Now, we all know we all have errors and omissions insurance, but, it's required. It's been required for, since Ginny Mae was born. And most importantly, we all know that it is just something that is the go-to insurance, but none of us make claims against it. And if you do, you're generally unsuccessful. So rep and warrant was more of a transactional idea we came up with in the early 90s. And I literally packed the idea up and shopped around to Philadelphia, where all the insurance companies are. And I end up getting put into a forced place coverage unit of all things relative to rep and warrant. Marc, you can relate to that. How can you have rep and warrant coverage and forced place coverage combined together? It just makes no sense. But that's what they thought about it back then. And so when I talk about rep and warrant coverage, really what I designed was an ability for a lender to say, look, I've got this coverage. I know you want me to buy this loan back. Maybe we can get the third party that caused the fraud or caused the problem to come up with the money. And in the meantime, the insurance will be as backstop for it. And that was before the new systems that are in place now, like we have rebuttal and we have impasse and we have management as it relates to buyback on loans. And we've been working that, and we actually help with some of the design systems behind that. So when it came time for a repurchase request, the rep and warrant back before the implosion of 2007, 2008 was really ubiquitous in the secondary market. We were insuring most of the loans on the securitization side. The good news is we didn't insure any subprime loans at the time. And that's right. And we had certain provisions in the policy that protected us so that if a company became insolvent, the policy is no longer valid. That has changed since then, but we're talking 20 something years ago, and we survived through it. And just to make it clear for your listeners, David, it's important to note that the coverage actually was designed by lenders. And that's important.
Interesting.
We had a table of half the table was insurance carriers, the other half were lenders. Insurance carriers didn't want to pay a single claim, and the lenders, wanted everything covered. And it ultimately fell down to the lenders saying, we won't buy it if it's something that will easily be denied. And so we designed the coverage for that. But we became particular in who we took care of. And you were one of them, David, Mr. David Lykken. You were one of them back in the day, some 20 something years ago. And since then, we have gone through many iterations and adoptions, and we'll get into that a little bit. But in this particular market, I'd like to bring it up to date, if that's okay.
Yeah, please do. Please do.
We are in trying times. I don't know if everybody read Angel Oak just sold $400 million at 83 cents on a dollar, a non-QM product. And that's simply because of, the current market conditions and the spreads and the mark-to-markets and the volatility. Those things are affecting everybody. And we all understand that. So the question is, how can you stay in business, make some money, be a little bit more judicious in your approach, and at the same time have a company that is a member of Lloyd's of London back behind you, just in case there's a problem. And that's where we're at today. So that's my story.
Yeah, it's a great story. And I want to get into what's sparking the growth in the non-QM market. And then we'll toss the question over to Marc and then get back to you, David, and jump in on this. But what is the reason for the growth in the non-QM?
Well, you're asking me, I would imagine.
Yes.
I would simply say it's twofold. One, when you have less volume, you'd like to make more money per loan. And non-QM is clearly more profitable from a net income standpoint.
Right.
We won't talk about risk right now, but we'll talk about for every 10, essentially QM loans, 2 or 3 non-QM loans make up the difference in the net profit.
Right.
So There is that. And it's something, and I want to bring this out, and I'm sure everybody can agree with this. Since COVID, there's been extraordinary expansion in the percentage of freelancers and independent workers. Look at yourself there, Mr. Lykken. And more importantly, it's been a situation where you have self-employed people that don't necessarily have traditional documentation.
Right.
And we're looking at 53% of the workforce fill into that. Now, when you start looking at non-QM, well, non-QM was less attractive when you had a high-flying, low interest rates refinance market.
Right.
And when you don't, you have to actually work for your money. And that's what these mortgage bankers are now looking at. And companies like Angel Oak, but I also mentioned Acra Lending. Acra is in the non-QM market, and they're also very judicious and growing their corresponding group, of course, very carefully. So long as there's specialization in the underwriting, because non-QM is an important feature.
Marc, we'll toss the mic to you.
It's interesting the concept of what you've been working on, because it's I go way back. I always get branded with servicing, but I started off in originations and was a area manager and regional manager.
You're brilliant in all aspects of the industry.
But one of the things I got to work on is something you touched on when you first started the podcast. I got to work on the lender place coverage side. I got to know the Lloyd's market extremely well. I worked with the first couple companies that took lender place to a new level, where lender place was not just covering the mortgage company, but really was covering the borrower just as much as the mortgage company on the long term. Because originally it was just trying to cover the asset for the loan, and then became insurance for the whole value and all that. So the reps and warranties right now couldn't be at a better time, because I agree with Mr. Kittle. This is the time when the agencies are going to look at everything. I can tell you from the approval process with GSEs, it is really tough these days to get somebody made to Z and get an approval. It's because they're crossing T's and dotting I's on everything. And I'm sure they're going to do that on the reps and warrants as we get on the road. So what you're working on is going to be extremely important for the industry. And I'm excited to hear about it. I really am.
Arthur, what are some of the non-QM characteristics that are their impact on the repurchase requests that are going on right now?
Well, one of the things that we've been working with Milliman, they have some proprietary data that they have crunched over the last few months, given the current marketplace. And in a comparison between QM and non-QM, there's almost a 6 times greater default rate.
Yeah.
So default rate obviously is what we look at as it relates to our underwriting for insurance product like a non-QM. If it has a 6 times default rate based upon their characteristics, clearly that raises the question of scrutiny by the GSEs. And once that occurs, then that increases the number of repurchase requests. But I want to make a comment upon something relative to that. Since 2008, systems relative to repurchases are far and away more advanced relative to algorithms, flagging, and most importantly, origination processes. And we will get into this later, and I know I'll comment on it, because of the advent of the use of vendors pretty much doing most of the business for these mortgage bankers. I think it's important to remember that there's been this symmetrical war going on between the vendors and the GSEs and the investors on the same side, analyzing loans for potential risk associated with repurchases. Has that increased? Well, we all know that when there's a lot less to do with the investors, the first thing they're going to do is look at loans they can put back. Yep. And that's what they've been doing. There's no question about it. For example, we have a number of lenders that we've recently insured, and they have come to us and they said, can we do a retroactive insurance? Which was amazing. And I created this. Actually, it's been around, but we have not issued it, nor have we underwrote it. Is that the right word? Underwritten. Underwritten it. Yeah, right. We haven't really identified the right pool to do that with for quite some time. We do now in this particular market, and we have created a process where we can actually underwrite the last 2 years of loans and protect those loans against rep and warranty coverage.
Kittle told me about this when we were talking, and that's why he says, you got to get Arthur on the podcast. You got to, and when it was the retro part, Kittle, that you started talking to me about, Mr. Kittle. David and I are really good friends. For those of you new to listen to the podcast, Kittle Lykken, we always go by last name because it's David. So Mr. Kittle, we'll go Mr. Kittles for those that are listening for the first time. But Mr. Kittle, you talked about this, and I'd love to have you expound what this means to the independent mortgage banker. This is huge. Retroactive insurance, repurchase insurance, amazing.
I will tell you what it does, go back to the 3 lending companies I have. It absolutely protects my assets and protects all my cash. It takes 1 or 2, maybe 3 repurchases to cover what you're going to spend on what Arthur can go back for 2 years of originations, do a cursory underwrite to see how it is. We'll use Evolve to do the underwrite and put a wrap policy on it. You want to talk about peace of mind at night?
As another example, a relationship that actually David sent us, we insured them. We insured their flow business. They sent us a tape of 2,000 loans that date back to 2020. And we put a wrap on it. And it's fairly inexpensive. Comparatively, we're not going to talk prices here, but obviously it varies. But most importantly, we were able to successfully put a wrap on it.
Wow. That is, Marc, you and I, when we've owned our mortgage companies, David, Kittle, myself, and you, we've all owned mortgage companies. To have this peace of mind, Marc, what is this going to do for so many lenders that are facing, really, they're already feeling up against the ropes in so many cases?
I know a couple lenders now that kind of wish they had it, I'm sure. Arthur, let me ask the question. Does since I don't understand the basics of the coverage, is there a some type of deductible that works on the loan balance or something like that? Surely it's not 100% insurance. So, yeah.
Well,
can you expound on that a little bit?
Sure, I sure can. Now, yes, there is a deductible and there's a per loan limit, and then there's an aggregate, and each loan is covered for a particular period of time. Because I designed this and because I have the pen associated with it, and my carriers we've been working with together for over 26 years. We have a very strong relationship and been very successful at doing what we do. We can design the coverage for each lender, and we can go up to, essentially $1.5 million in losses per loan. So it is, there really isn't any loan that we can't insure if it meets our requirements, and I mean risk requirements. And a lot of it has to do with the characteristics of the particular lender. And I don't mean product, I mean characteristics of the culture of the company. The culture, as the 3 of you know, culture is probably the key element when you're taking a look at partnering with them and taking care of their back. And what I mean by that is, I said earlier, I've cut my teeth in the law, which meant that I was empathetic to the needs of that mortgage banker, especially as relates to a purchase request. So we become specialists on rebuttals and impasse and management issues. And so that is the toolbox that also comes with this. It also comes with third-party reviews of the services that were provided that may have triggered that repurchase request. So all of these things are what's going on in the industry as a whole. And that is all of us working together to limit these losses so they're not so draconian for that particular lender.
So you do have an aggregate loss for the company you're working with, much like an E&O has an aggregate loss, right?
That's right. That's exactly right.
Loss limit, I should say. Let me ask you one other question, because I'm trying to just get my hand around this really solid.
Sure.
When you insure a loan and has some issues and repurchase is requested,
sure,
a lot about what the net loss on that is really what the lender does with that loan.
That's right.
Whether they try to do a workout, whether they try to do how they sell it aggressively, how they end up selling the net REO if it gets that far, et cetera. What kind of safeguards does an insurance company have to put around the fact that they just can't have a lender liquidate the asset, come up with a loss, and say this is it without making sure that lender is the lender is taking care of the insurance company like the insurance company is taking care of the lender.
Right. Some 25 years ago, we borrowed a page from the MI companies and how they resolve those same issues. And negotiated settlements have to be approved. We're all part of that process. In many instances, it becomes multi-layered, meaning that the third-party vendor could be a credit bureau, credit reporting service that missed something, and that was what triggered it. And they're involved in the resolution process as well. So think in terms of MI, and don't think in terms of subrogation in the classic sense, meaning we'll pay a claim and then go after third parties. It means that we're in this together as partners to resolve it together. And so in some instances, we've got very cooperative borrowers, as a matter of fact. If they lied or somehow made a mistake in undisclosed liability, we're there for them too. And in the meantime, we go to scratch and dent, cover the loss. Who knows? Well, the borrower might even kick in some dollars. You never know. So that's how we resolve things.
Well, I just came up with your sales byline for the coverage. It's called quotes, I got your back, because you're bringing these years of experience together to really have the back of the lender. And I think that's very, very important right now, especially with these stressful times we're going through.
That's right. Well, in our history, we've insured over $600 billion of loans, and we've had thousands of claims, thousands resolved, and most of our business comes from referrals. So that's basically, that should tell you all things.
So David, can I throw something in there, please?
Please.
So here we are, important what Arthur just said, is that he actually pays the claim. All right, not one of them, but there have been hundreds of this out there, and competition of this over the years that haven't. And it's important to know that if it's a claim that is right and just, it's going to be paid. I want to ask, I have a little bit of knowledge about what Arthur does, so I'm really dangerous with this. And Arthur, you may have mentioned it, but you are of counsel, and you should mention maybe that aspect of what you do, and that the lender possibly, has representation through this as well. So would you opine on that?
Yeah, sure. We have a relationship, and I in particular have a relationship with Offutt Kerman. We have over 250 lawyers in the group, and with very high level specialists in the area of everything from borrower fraud to secondary market issues. In fact, we have a number of lawsuits in the Sprout issue that everybody somehow been recently affected with, which is a matter of public knowledge. So that toolbox is also part of the process. We also utilize Evolve Mortgage Services for our specialists rebuttal process, so that when a loan does come in and maybe we could rebut it. And I don't know, David, this might segue into another question, but there's been a problem with a lot of lenders. We've had a lot of talent go, and we'll get into that in a second. But as a result, specialists are important these days, and so we wrap legal with underwriting, with insurance all together to provide the perfect solution for any size lender. That's the point.
So Arthur, you were talking about the impact of layoffs and the reduction of staff. A lot of expertise that, quite honestly, the good times we didn't necessarily need has been laid off, mistakenly so in some cases. But what your solution does is comes in and backfills those layoffs and provides that. Expound on that some more.
Sure. Well, again, we're constantly innovating based upon current needs, especially from the insurance, legal, and mortgage banking services environment. And one of the things we're missing a lot of days is a lot of good friends have been working at a lot of wonderful companies who had to go simply because of the reduction in forces that have occurred lately with many of these companies. We're all witnessing it from both the origination side to the secondary market side, as well as the vendor side. And what's happened is that the first to go in many instances, not the salespeople per se, but the underwriters. There's less loans to underwrite. And underwriters also serve another purpose. In many instances, especially depending upon the size of the company, they're used to rebut repurchase requests because they have the talent, or they may have actually underwritten that particular loan, and therefore can they have the expertise and background behind it. The
Right.
problem is if you let that person go, who then stands in the position of saying, well, here are the reasons why we feel this should be rebutted successfully? Well, and many of these, executives are in the C-suite, or now the files are dropping off on their desks. They've got boxes on either side of their desk. They're behind on the rebuttals. They're pulling their hair out. They're trying to make $1. At the same time, they have to deal with this profit-making adventure. So one of the things that we do, and we've been done for years, because we're a partner of the game, we're sharing in the risk. We look to companies like, in particular, our partner Evolve Mortgage Services. They have this expertise. We've insured thousands and thousands of loans with them over the course of 10 years. And just to give you guys a background, took 5 years for them to even be approved for the insurance. We had to track them for claims for 5 years. And this was back in 16, 17. And we've been insuring them ever since because their processes are capable of being underwritten for insurance. Simply put, if they make an error, it's insured. So they also are very talented at rebuttal. And their rebuttal saves us money from the insurance claim standpoint, to be black and white. So we like to use them. So when you get the insurance, you're also getting the rebuttal services. So the insurance therefore applies. You say, hey, look, Arthur, we got this repurchase request. I said, fine, let's take a look at it. Looks like there was an underwriting error. That's something that we cover if you use Evolve to underwrite it. But if you didn't, that's okay too, because we want Evolve to rebut it and use their expertise to do so at no cost. So it's already built in, and that has been used to the point where it's saved companies. Literally has saved companies.
Oh, yeah.
Companies that have a $25 million net worth 8 months ago now are at $7 or $8 million, and all it takes is 10 repurchases and you're done. So that's one of the solutions that come as part of the quest.
Yeah, and the other thing is many have got in for the reason the margins got tight. They went into the non-QM, which you alluded to earlier, and they're not experts on non-QM lending. And as a result,
That's right.
you got that. And then they laid off the underwriter that underwrote that loan, which really goes to the point of having that expertise. We've seen, I want to go to Marc and get some feedback on this, because Marc, we've seen this happen over and over again in the different cycles. Comment on this and give us some color on that.
Well, I think it's kind of unique because I see it not only, sometimes we see when we get into first payment defaults, another thing in servicing on a non-QM loan, we see the problems that were born out of the origination cycle, and we see repurchases and other things come up during that period of time. So we're looking at that, but I think things are gonna, it's pretty common for that to happen. And so it's not always something that just happens right up front, early on in the loan and is caught by an underwriter. But I think the thing that I like what Arthur's talking about here that really brings the whole picture into play, that's really kind of neat. You not only have an insuring body that's insuring you and got your back, so to speak, but you have this tentacles of experience reaching out in all areas that are going to be a multitude of folds better than what you have internal to your mortgage company and to your general counsel you have for your mortgage company. Right. That's on your side, that's going to be helping you fight those things. And I think that's one of the biggest value of the product is having that network, so to speak, of all that support. And I think it's something very much needed because honestly and truly, especially on the non-QM side, if we start having problems with that, and we don't have something like this, it's going to kill that market, just like some things got killed in the market here recently because of the rising interest rates. We'll see a dying of the market, so to speak. And then it takes, as Mr. Kittle knows, sometimes it takes a couple of lending cycles for those things to get their feet back on the ground and come back. So I really like the way this conversation is going, the product. And I'm thinking of probably at least a dozen people I could refer this product to right now that probably need it more than they think they need it.
Yeah.
I'm thinking of all the people that all the clients I want to take this out to and bring this out to. Yeah, it's just, and
think of the numbers out there for a second, David. And it's just, especially the IMBs. Look, the banks will certainly understand it when they start getting repurchase requests, because as a whole, and I'm not talking derogatorily about anything, but banks have the mortgage division. That's not normally what they specialize in.
Right.
And so when repurchases come, they're going to be very surprised and not happy about it.
Mm-hmm.
Whereas IMBs, it is the livelihood for them. And, to Marc's point, it's why I wanted to point it out earlier with Arthur and bring up the fact that he's of counsel with Alfred Kerman.
Yeah.
Is the fact that this is just not an insurance product. My car got hit. Would you fix my fender? Thanks.
Yeah. I just got involved in, it's like the guy that had the auto accidents calling from as he's looking at his damaged car and he's going, hey, Arthur, I want to get insurance for my car. By the way, I just got T-boned and I don't know if it's total or not, but would you mind writing insurance policy? It's what it sounds like.
Right.
I'm going like, what the heck? When David Kittle brought this up, I was going, are you serious? Retro? So
right.
Here's the question that I hear listeners asking as I'm thinking about our audience. Okay, all of a sudden, everyone's going to start clamoring through your phone to get a hold of you. What is the capacity that you have to really insure? Is there a limit to the number of companies that you can insure? Is there a dollar amount? What are the limitations, Arthur?
Well, we write somewhere in a range of 10 to 20 billion annually. So it's not something that limits us. I will say this, it's a somewhat exclusive club too. This is not E&O insurance. I mean, if you can qualify, and it's not that it's difficult qualifying, but if you can, and it's not that hard, it's pretty much a 1 week turnaround in terms of the approval process.
1 week, as little as 1 week, you'll get approved.
Yeah, 1 week, so long as we get all data in place.
Yeah,
like I said, we've been doing this for almost 30 years. So it's been like this for quite some time, and our algorithms are long in place. We run it through our systems. We understand our risks. Our modeling is changed almost daily. So we're constantly taking in new information. That's why the non-QM market is important to us, simply because we're very careful at who we want to underwrite and who we will approve, because as we all know, that's a very specialized area, which is why it doesn't exceed 5 to 10% of the overall marketplace. It will probably go higher, but we're going to be very careful in who we select and who our partners are going to be.
Oh, may I add something to that? It just comes to mind, if you haven't taken care of yourself, your personal culture, to Arthur's point earlier, to your company,
that's where I was going.
Haven't taken care of yourself, you're probably not going to get the life insurance at the rate you want, or you may get turned down. It's the same thing. If you haven't taken care, have company integrity and culture, then you're probably not going to be accepted into Arthur's program. So it has.
Which goes, Dave.
That's fair.
Yeah, that's really fair. And which also goes to the importance of having really solid systems. And the conversation would be worth having with you, Arthur, just to find out if we do qualify. And if not, what the heck do I need to fix about my company moving forward? So just the dialogue in itself, whether they can get it and they qualify or not. Is it that difficult to qualify for, Arthur? You were talking about it like we talk like this panacea, like everyone could get it. It's not a insurance, or everyone has to get it, kind of.
That's right.
But how difficult is it to get this type of insurance?
Well, it's not that difficult depending upon your prior history. And the bios of your C-suite, where you are in the industry, your commitment to the borrowers, and your commitment to the secondary market. Those things you can always, it's in the smell test that you can always walk in and you see, and look, I've been doing this for a long time. So I've fond or not so fond memories of the SNL crisis, and walking into, offices that have leather tile ceilings and built like castles, and, and they stopped paying rent on that a long time ago. I think everybody knows when you walk inside a company that's been there and is still there today, by the way, you understand how they've been managed and how they've been operating. And that's part of it. And granted, yes, we have financial and analytics that we and tool sets that we use relative to understanding the risk and demographics and so forth. All of that comes into play similarly the way you get approved for a warehouse bank. But at the same time, this is more about a partnership, and we have to be there for you. There's been instances where we've had lenders that we thought we approved, and they went ahead and did a scratch and dent without approvals, or they tried to find ways to make claims, even though they're the ones who created the fraud, that kind of stuff. And you understand where this is coming from early on in this business. And so now we're very particular. So is it very hard? No, it's not that hard. But if you stand out as one of those companies that probably won't be around in a year from now, you obviously can tell that.
Yeah, you can tell. I think Mr. Kittle used a great analogy there is someone who's getting life insurance. A smoker is not going to be paying, is going to be paying higher premiums, even if they can get the insurance.
That's right.
Some with unusually high blood pressure, all the others. So there's a lot of great metaphors when it comes to the insurance world. There's just so much. I want to start looking forward into.
Can I add something there? Something,
yes,
Dave?
Yes, David, please do.
To the other side of it, just because you've behaved and done a good job and done your very best with integrity and training of your loan officers doesn't mean you're not going to get a repurchase request. Ready. So
that's right.
You say, well, I've got to. Well, it still doesn't mean you're not going to get a loan thrown back. So you need to take a look at this.
And Marc, that's a great point. Marc, we both have been in this for a long, long time. We work with the agencies to get companies approved. We tell people you're going to get approval. I mean, if you're doing business and you're doing it in a way that's really benefiting the consumer, you are going to get repurchases. Not that you're going out and pushing the limits irresponsibly. Right. It's just a matter of doing the business. Arthur, we've talked a lot about what you're doing now, but there's vendors that are involved in this. There's different aspects. Would you wrap this interview up by sharing what have we not covered?
This industry, David, is interesting and unique simply because it's unlike any other industry where other industries, if you go to Home Depot and you buy something from Home Depot, you could simply return it. They'll give you credits for it. Our industry, you use a service, they have lengthy indemnification provisions that limit their liability. And there are what I consider cutting edge companies, vendors out there that are saying, we're willing to put our money where our mouth is. If we make a mistake and you get a repurchase request, guess what? We're going to stand up and cover that net loss because we've got an insurance policy in place. So we also have a vendor policy, essentially a policy that says, and I'll use an example, Exactus has this policy. Essentially, if there's a credit report, you receive the credit report from Exactus and turns out there was an error, something that was missed on it, they'll cover it simply through the insurance. They've stepped up and done it. Voxter, another great company. Voxter, I don't know if everybody's familiar with Voxter. Voxter, one of their primary products is an AOL, which is basically an attorney opinion letter. And they were able to get FHA approval. Fannie, Freddie now uses them. They're ubiquitous. And they basically have a bond, of course, typical title insurance type bond. But because affordable housing is such an important issue now, it reduces significant costs as opposed to title insurance by almost $2,000-3,000. And they have a transactional coverage, which is the rep and warranty coverage. So if the loan is sold and there's a title issue, which eventually is put back because of that, the insurance kicks in as well. So all these vendors are stepping up. A lender is wise to take a look at a vendor and ask, do they have some rep and warranty coverage?
Really good point. There's so much here. Marc, I want to get you as we wrap up this, then go to you, Mr. Kittle, and we'll get to you back, you, Arthur, for final wrap up comments. Yes, sir.
I'm going to jump in here now since I had myself muted out and was trying to go out the door, as you could tell. But anyway, two quick questions for you, Arthur. Number one, I'm assuming the insurance structure for the insurance you have is atypical a little bit to Lloyd's in that you have a lead broker and then underneath that people are sharing the risk. Is that true? Is it like the lender-placed coverage and others?
It's similar in that it's underwritten by a particular insurance company within the umbrella of the Lloyd's. And if it does exceed beyond that, yes, the umbrella, but it never would and never could.
Okay. And the other question I have, I was on the board of a company that recently sold, and I'd never seen this before. They were able to buy a policy, a reps and warrant insurance policy on their deal, on loans on their deal. Are you involved with that side of the business any?
Yeah, but we actually do it in a couple of different ways. One is a wrap, like you just suggested. Yes, we can do that. But more importantly, to avoid that 10% holdback on repurchases on a loan, on a business that's been sold, and there's a trail of liability, we'll cover the trail. So the answer to that question is yes.
Mr. Kittle, I want to say thank you so much for suggesting we have Arthur on. I've always been a fan of him. I've worked with him. And one of the things I recommend listeners is you hear Arthur's what he's created as a result of needs in the marketplace right now. But there are other needs out there. What I love having partners with that I can talk to that are thinking out of the box. They go, that's an interesting problem. Let me see if there's not a solution to it. That's another reason why you want to be in relationship with Arthur Prieston. He is a guy that thinks out of the box and is always looking for solutions. You don't know that you have a problem that Arthur can't create a product for. David Kittle, you know this about him so well. Comment on this and then we'll call it a day. Call it an interview.
Well, I think that was great comments. I think about, I'm as well as everybody on this call, we're all about the relationships we've made over 35, 40 years in this business. And I certainly care about my relationships and my friendships. People inside the Mortgage Collaborative, 280 lenders, our vendors inside TMC, but also all those people that I know outside. And it's just something that I know that they should look at because we've all been through these cycles. We're going to see as much or more repurchase in this particular environment than we've seen in the last 10, 15 years. And I just want my friends to be prepared for it.
Yeah. And then prepared with a good friendship. And then once you get to have a friendship with Arthur, you're going to enjoy the journey. It is just a quality human being. He's got things out of the box and is a lot of fun to hang with. In addition to that, Arthur, thank you so much for being here. How can people reach you and connect with you? I'm sure you're going to get a lot of phone calls out of this.
Well, PriestonCapital.com and
spell Prieston for us. For those of us who can't spell Prieston for us.
Well, it's like son of a priest. It's
okay.
Prieston.
Yep.
Capital, PriestonCapital.com. And also you can email me at aprieston@PriestonCapital.com.
And by the way, that's capital with an A.
That's funny. Well, Arthur, it's been a joy to have you on. It's
been a joy.
It is. I mean, the years and years of us working together, it's just an honor to have you here. And I encourage our listeners to reach out to you. David and Marc, thank you for joining me on the interview here. It's always a delight to have you join on the microphone. It's great. Thank you.
Welcome. Merry Christmas, David.
Merry Christmas to everybody.
Same here, guys.
You've been listening to Lykken on Lending, a weekly mortgage market update with your host, David Lykken of Transformational Mortgage Solutions. Join us next week, and thanks for listening.